Hey, what's up everybody? You just went into business for yourself. You might call that something different. Hey, I started a side gig, I still got my main job, or I just left my job to open this up. Whatever, you're in business for yourself. You're no longer getting a paycheck from a company or someone else, but you're in business for yourself. What's the number one mistake you're gonna make? My name is Brad, I'm with Wooten CPA. My goal is to bring peace to your finance and tax responsibilities. Please subscribe to the channel and hit the bell so you're notified when new videos come out. Thank you for watching. Here's what it is. You're going to forget to pay your taxes, and then you're gonna get surprised at tax time where you either don't have the money, plus you owe a little bit of extra interest on it because you didn't pay it at the right time. So that's the number one mistake when people, in the year that they switch from being an employee to being self-employed, is they don't think about taxes, right? So you were working for company XYZ, they were giving you a paycheck, they were withholding taxes, federal income taxes, plus Social Security and Medicare, which are FICA taxes for the Social Security and Medicare benefits. They withhold those taxes from your paycheck. You know, you get paid $1,000 a week, they withhold these, now you get $800, all right? And then at the end of the day, you go to do your tax return, you fill it out, and you get a refund. Because generally, the Social Security and Medicare, I mean, that's exact. They withhold what they should because it's an exact amount. The federal income tax withholding is a guess based on federal income tax withholding tables that are generally set up to withhold more than what you actually owe based on the W-4 that you fill out. So you likely will get a refund. You leave that job and now you're making money. Okay, I made $1,000 this week, I made $1,000 this week. No one is withholding any taxes for you. And you go to do your tax return and you put down, I made $50,000 of taxes, of income this year. Well, no one withheld Social Security and Medicare, which is withholding from your check at 7.5%. But now that you are both the employer and the employee, you're self-employed, you don't owe that 7.65%, you owe the full amount, 15.3%. So now you owe Social Security and Medicare, not through FICA, it's through SECA, but it's the same taxes, Social Security and Medicare on your net income. You also owe income tax, but there's no federal income tax withholding that has happened during the year. So you owe these taxes that usually is kind of in the back of your mind. You think, okay, you know, my paycheck, why is it so small? I make this much, oh, it's taxes, blah, blah, blah. But now no one was doing that for you. And you didn't think about doing it during the year. So at tax time, boom, you made $50,000 of income net after expenses. That's your taxable income, $50,000. Then, okay, that's probably about 15 grand between the self-employment taxes and the income taxes. Again, not taking into account the standard deduction, if that's the net amount. But it's going to be a lot in tax. It's going to feel like a lot more than it did before because one, it kind of is. You're paying more Social Security and Medicare taxes than you were before because the company was covering half of that. But then also it's hitting you all at once instead of being deducted little by little from every paycheck. So what you need to do now before tax time comes around, at a minimum, you need to set aside some amount of money every time you get paid so that you have it to pay the taxes when they come due. That's a minimum, all right? Now, general rule of thumb is about a third of what you got coming in as a self-employed person. So again, self-employment taxes are gonna be 15%, plus the bottom tax rate is 10%. So you're looking at 25% right there. Now you got the standard deduction, maybe you got some business expenses, but rule of thumb is a third because it's probably gonna be more than enough, all right? If you set aside 20 to 25%, you still might be just fine, all right? But that's rule of thumb, set it aside so you have it when you get to tax time. The second one, which is even better, is you need to do estimated tax payments. So again, you could use that same percentage, somewhere between 20 to 33%. And that's not gonna apply for everyone. Some people might be lower than that, some might be higher. Depends on your unique situation and what else is going on. There's a lot of things that are personal to you where I can't just give a blanket statement like that. But the next best thing is to make some estimated tax payments. So you can either do it yourself using that third safe kind of number and make those estimated tax payments, or you can actually find a professional who will help you do the tax return it's still based on expectations, because right now you don't know what you're gonna make this year, but you have a good idea. Here's what I think I'm gonna make. Let's do the tax return based on that. Figure out what the estimated tax payments should be and make those. That's gonna definitely be more accurate than just a blanket set aside a third, because we're going to actually look at your situation, what's going on outside the business, what you think the business is going to make, do the tax return, see what the taxes are going to be, and then pay those. The tax code says you have to pay in those taxes quarterly. April 15th, June 15th, September 15th, and then January 15th of the following year. So January to March to April, you make a quarterly tax payment. The next one, you make a quarterly tax payment. So you have to pay those in. If you don't, and you wait until March or April of the next year to pay those taxes, you will have interest that you have to pay.